Retire early running the wheel strategy options on Palantir, $20,000 a month tutorial. Buy options with Ryan. I'm not sure why people think that running the wheel is a good strategy. You're much better off if you get assigned the puts to simply hold on to it, but selling covered calls on your shares is a losing strategy. That's why every single covered call ETF dramatically underperforms the market. You're basically trading dollars for pennies because you're giving up the upside potential. Also, Ryan has a history of manipulating his account value, and I don't think his followers make money either. If you look at this comment that someone left, where someone said, "I lost a lot of money because of you," then Ryan said, "Then leave my channel or apply for my mentorship because you ain't doing it right. I haven't lost a dime this year. All my clients up huge." I think the probability that he's telling the truth there is close to 0%. And I would love the opportunity to subpoena his statements, especially considering that in the last video that I made of him, it showed that virtually every single one of his positions was down money. But let's see what he says about running the wheel on Palantir.
In this video, I'm going to show you exactly how to run the wheel strategy using options on Palantir to make $20,000 a month. If you take a look at my portfolio right now, currently at 935,000. Let's hit the refresh button to make sure this is up to date. 935,000. And I do plan on turning this into $10 million in the next 7 to...
Yeah, he's going to turn it into $10 million by using money from his viewers and then depositing it into his account so that it artificially inflates the account value.
Now, I'm going to show you my realized gain loss for this month. Actually, today, $5,249, utilizing the same strategy I'm going to show you. Okay, and we're going to put this custom date range to today or this month so you could see exactly how much this wheel strategy has generated me. As you can see, $46,000 in profit with a 100% win rate. So the strategy works, and Palantir, I believe, is the best stock to do this on going forward. And I'm going to get into the exact strategy and why I think Palantir is the best stock to run the wheel strategy on. But before we get into it,
look at this. This is interesting. I'm not sure what a transitioned account is, but that leads me to believe that he has multiple accounts inside TD and he's potentially opening up new accounts and closing others. But I could be wrong on that. It's just weird. I've never seen that language before.
Now let's go ahead and jump into the wheel strategy. So for those who have never heard about this strategy, or maybe you've heard a little bit about it, I'm going to get into the exact, what a sell.
Right. So basically you sell puts, you collect premium, you wait to get assigned, then you sell covered calls, and then you profit off the capital appreciation and also the premium collected from selling the covered calls. The problem is that this type of strategy caps your upside potential. And during times when the market pulls back by 10, 20, or 30%, you're basically trading dollars for pennies because you're losing dollars on the downside as the stock decreases in value, and you're only picking up a few pennies when you sell the covered calls. Then, to make matters worse, because the covered calls cap your upside potential, if the market rebounds sharply and goes up 9 straight days like it did in 2025 when it bounced off the bottom, your shares are going to get called away from you at a loss. And this is one of the primary reasons why every single covered call ETF dramatically underperforms the market. So let's check out XYLD. We can see that over the past 5 years, it's down tremendously. In early 2020, it was trading at around $50. Then after the crash, you can see that it fell all the way down to 35. And now is currently trading at about 37. Let's check out QYLD. Initially, in 2014, it was trading at $26. And now it's trading at $16.
Number one, we're going to sell 25 to 35 delta cash secured puts, depending on how bullish you are. So how it works, we're going to look at the diagram. Let's just say the stock is trading at $126 right here. We're going to sell a put at 120, which let's just say has a 35% chance of getting assigned and a 65% chance of not getting assigned. So let's just say this month, Palantir goes up to 129, 130, right? And our put here expires worthless. Buy it in 30 days, expires worthless, right? So we collected our premium and now we could do it all over again. The next month, we do the same thing. We sell the 120, stock stays above 120, and we collect our premium and do it all over again. Closer you get to the stock, the more premium you get paid. Think of it like stock insurance or like car insurance, right? People are protecting their shares by buying these puts that most of the time they expire worthless, just like car insurance. We pay for car insurance, but I still want income. So that would be essentially the 150 strike. It's an 18 delta, but we'll go to the 150 strike.
So we're going to sell the call options.
Then we also get to collect the covered call income. So we're going to sell 30 delta covered calls, 30 to 20 delta, anywhere in that range on Palantir. We're going to go 20 to 30 days out for monthly income. Enter on green days, so when the stock goes up there. So, and I'm going to go to the 20 delta, okay? Because I want a lot of appreciation, but I still want income. So that would be essentially the 150 strike. It's an 18 delta, but we'll go to the 150 strike. And this has happened to me before many times on Palantir. So let's calculate that. All right, so the bucks worth of, Palantir divided by 125, and we got 1.5% on covered calling.
The other issue with selling covered calls is that it takes away a lot of your freedom and flexibility. Let's say the stock shoots up and you think that it's overvalued. You're going to be hesitant to close out that position and sell your shares if you've already sold a covered call on that position, because the covered call is going to have a lot of extrinsic and time premium left that you're going to have to buy back. If you're really bullish on a stock like Palantir, there are way better ways of structuring a trade than simply running the wheel strategy. The wheel strategy almost always underperforms the market, and it does most horrible during pullbacks, and it also doesn't keep up during a bull market.
Okay, so what we do is we buy 70 delta leaps call options. That's basically a call option that expires in 365 days or...
Buying leaps on something like Palantir is not necessarily the worst idea. It does have high implied volatility, so you're going to be spending a lot of money on the call options. I would personally prefer to buy leaps on Palantir than I would run the wheel, but there are way better ways of structuring the transaction. But overall, I don't believe that following the advice that's provided in this video is worthwhile. In fact, I think it'll dramatically underperform the market, and long term, I think it could potentially even cost you money. If you have any questions, leave a comment below. And watch the video that's popping up on your screen right now, because YouTube believes that you would enjoy it the most.